I'm Jim Cramer, and welcome to my world.
You need to get in the game.
Firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
I always like to say there's a bull market somewhere. And I promise
Mad money. You can't afford to miss it.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends? I'm just trying to save you a little money. My job is not just to entertain you, but to educate you. So call me at 1-800-743-CNBC. After the 10th straight up day in this market, seemingly endless winning streak, a day where the Dow gained 84 points, S&P climbed 0.56%, NASDAQ advanced 0.43%, we need to talk about something that a lot of people have been taking issue with lately, including things that I've been saying on the show, and that's the Fed's role in this stock market rally. Typically, I don't like to bore you about this stuff, but we're not going to make it boring. We're going to make it clear, interesting, and action-oriented. Here's what we're going to do. See, there's no denying that the Fed has created an environment where companies can do well and stocks can go higher. We know the Fed has allowed individuals and corporations to refinance, and that's been a gigantic part of what has made it possible for people to buy stocks and buy homes, and for companies to buy their own stock and to pay bigger dividends. Plus, by keeping money easy, the Fed has encouraged the buying of equities, in part as bond market substitutes, fixed income substitutes. Dividend-paying stocks often yield more than treasuries, and the tax treatment of dividends remains superior to and far more bountiful than that of bond market interest payments, the coupons, which are taxed at a much higher ordinary income rate. The Fed has also created very helpful investment climate here, but making it clear that it isn't about to stop its bond buying program anytime soon, no matter what the critics say, unless unemployment makes a quantum leap down to 6.5%. So yes, Ben Bernanke, he is the father of the bull market. That's for certain. And the Fed has been an incredibly important impetus behind this giant move. Now, there are tons of pessimists out there who believe that because the Fed created this environment, the Fed is doomed to destroy it. The moment they take away the punch bowl and they start tightening, they believe. I think that's wrong. And more important, I think you're getting ahead of yourself if that's really what you're worried about now. And people have been worried about that for a year now. Just because Bernanke made this bull market does not mean it is some pitiful, helpless orphan. I think the bull can probably actually stand on its own four legs. And even if it can't stand on its own now, I trust Bernanke not to start tightening until we're at a place where it will be able to stand and he will not crush the stock market. But the crucial point is that's not where we are right now, even as you hear it being asked and talked about endlessly. It's not where we are right now. For the last 5 years, I have told you over and over again that you have to get out of bonds and into stocks for as long as this period lasts. In other words, as long as the Fed is being benign, as long as Bernanke is saying let there be profits, then I think you should be trying to make as much money as possible. Sure, it has to end one day, and maybe it'll end badly. But while it lasts, I think you'd be nuts not to try to benefit from it. In other words, I'm a huge believer that you won't necessarily be able to catch the top in pretty much any stock, any market, okay? But that, if you decide to be in, and you decide to be disciplined, you can get out with some very big winnings even after it starts going down. In my world, if you decide to sit things out simply because one day at some undefined point down the road it must end, then you're committing the ultimate sin of passing up on what might be a once-in-a-lifetime opportunity to make money. Plus, many of the companies that are doing well today are not at all expensive on an earnings basis, even unaided by the lack of serious competition from Bernanke-boosted bond market. To me, that means the risks of a precipitous sell-off are much lower if or when it does occur. And that makes it even more imperative that this rally not be blindly dismissed by bearish theoreticians who are so easily pushed into saying that disaster lurks around every single corner. Let's put it in arithmetic terms. Because there are so many high-quality, high-growth companies that sell at just around 13 times earnings or less, financials, tech companies, the risk that we could sell off horribly from here if the Fed starts tightening overnight isn't as miserably frightening to me as it would be if these stocks were selling at 19, 20, 21 times earnings like the 87 crash or some other times that we really went down a lot. The underlying companies were growing much more slowly then, sure. Now, listen, I know, yeah, I've got to tell you, if we moved up 7 to 10% higher from here, okay, now that's a different story. I wouldn't be saying these things. Up 7 to 10% higher, I would say, you know what, I don't like the odds. I think that there's a lot of selling to do. But here's the rub. If we were to rally 7 to 10% from here and then the Fed were to tighten quickly, we may not even go down 7% when it happens, because stocks will do better than bonds the real enemy in that scenario. And that's why I say the only people who don't need to be in stocks right now are the people who either don't invest it under any circumstances, it's against their charter, they don't believe in it, or they're the ones who are so rich that they don't need to risk anything and tell you not to. But remember, they only need to get rich once. I want to help you get rich. Naturally, these are the most vociferous critics of my approach to this market. Can these naysayers for once ever give any credit to corporate America, by the way? Because the companies actually have played a big hand in the rally, too. We've seen tremendous execution, great innovations, amazing loyalty to shareholders, the social contract, in terms of huge buybacks and fabulous dividend boosts. You see, Bernanke may have provided the opportunity, but he didn't provide the smarts. He didn't provide the execution. He just created a backdrop that allowed companies with good management and good businesses to prevail. But you never would have bothered to buy stocks if you believed that from the very get-go, this all had to end and end in tears. You would have avoided stocks the whole way, which is what was these people, I mean, that's kind of what they accomplish. Yeah, you would the whole way, or from any level where you heard these Jeremiahs about how the Fed could pull the rug out from under us at any minute. And that's what makes me so angry. I'm really angry this morning before spoke on the street. She's getting angry about this. I'm really steamed. You know why? I mean, just once, I'd like to hear one of these Fed-fearing bears to say, look, I acknowledge that my view would have kept you out of stocks for the last 1,000, 2,000, 3,000, 4,000, or maybe even 5,000 Dow points. And now I doubt, even if Bernanke leaves right now, that we will give up those points. But I do think it should be on your radar screen at some point. Oh, bliss. Would that be too much to ask? Is that too much for someone to admit? You know what the real irony here is? If the economy does get better, forcing the Fed to ratchet up rates, companies will do better. And stocks can do better. But bonds, they will almost always have to do worse. Always. I can't think of a single situation where you should be owning bonds right now, frankly, no matter what your age or your risk profile is. Those are way too dangerous. The idea of owning a dangerous U.S. long-term bond, selling at a big premium to par with that budget deficit we have? Oh, come on. You buy that stuff at 130 versus 100 where it was issued? First is, okay, Johnson & Johnson, a common stock with good dividend, much better balance sheet than the U.S. government. It makes no sense to me. Bernanke bashers tell people to sell their bonds. Get everyone to sell their long-term bond funds. That's how you could do us a service. But until they wise up, these bears will continue to be the enemy of your personal wealth. They've kept you from taking that opportunity, and they have no humility about it, and they have no remorse. They have nothing. They have no game at all. They simply don't think this rally counts. They don't think that it matters, that you could have made any money, even though it's right there. And worse, they think that these gains are ill-gotten. Here's my bottom line. Ill-gotten gains are gains that are stolen, expropriated, or looted. These stock market gains, they are totally legitimate, accepted at the bank, and at fine retail stores everywhere. So, while we acknowledge that this period of bountiful profits will eventually come to an end, that's not enough of a reason to keep you away from the market for as long as it lasts. When things go bad, believe me, the stocks will seem very defensive. And the bonds, as long as things are good, well, let's just say stocks have a lot more upside. That's right. What's traditionally defensive, the bond funds, could be lethal. And what's supposed to be risky, high-quality stocks with good dividends, even after this run, make the most sense to own. Margaret in Michigan. Margaret.
Good day, Mr. Cramer. Thank you so much for your help to the listeners.
Thank you.
Booyah to you.
Booyah.
And a boo-hoo from me.
Oh, what's the matter?
I've got Cliff's Natural Resources. I bought last year in the mid-40s, and it's way down. I am a long-term investor, and if you say hang on, I will.
Yeah, I got to. I mean, look, I got to tell you, I was talking about this literally with two other investment professionals today, and I said, look, they raised some capital, the balance sheet's better. Is there no level? You're going to need to have China go up for a couple of days, and that stock will rally 15%, and then we'll relook at it, Margaret, and then we make the move to go, but not down here. I don't want you to do it. The bears, they have no remorse whatsoever about keeping you out of this rally. Me, on the other hand, I got to tell you, I got to keep you in and get you out of those bond funds. That's what's going to crush you, the bonds, not the stocks. Mad Money be right back.